Okay guys, sir, last we were talking about which model or which method to be applied for which financial assets. So basically India is 109, we have given a start. What we have discussed is asset there are three possible methods, but for a liability there are only two possible methods, and we have seen the ground rules of each method. That means how to apply ACM, how to apply FETPL, and how to apply FET-OCI. What is the initial recognition measurement principles in that, what is the subsequent measurement principles, and how to account that, and how to account the interest income or interest expense, whether using EIR or without using EIR, and on the balance sheet date fair valuation is required or not required. All that we have seen. Then we started discussing when to apply FETPL, FET-OCI for investment in equity shares. Simply put, you have a choice, and that too it is a one-time choice, and it is not revocable again. You cannot change it back to other method. Whatever choice it is, either FETPL or FET-OCI, you got to make this decision on the initial recognition time. Whatever method you have selected, you got to live with that. Then accounting for financial assets other than equity instruments. Other than equity instruments, whatever financial assets are there, here also all the three methods are possible, but which method you will apply depends on business model test and contractual cash flow test. Business model test we check the objective of holding the financial asset, and in contractual cash flow test we test the rights emanating from financial asset. So here SPPA test is treated as passed only when you have right to receive cash flows which are in the nature of solely principal payment and interest. Any additional rights if you have, a test is treated as failed. Once this test fails, automatically you cannot apply ACM and FET-OCI. You are forced to apply only FETPL. Just because a D is passed, you cannot apply ACM or FET-OCI without passing A or B. So these have to be fulfilled in togetherness. So that is that. Here something I have written, you see, this is not relevant for exam, but this is what India's 109 gives a permission. For example, you have a financial asset. Your objective is to hold it till maturity. D point also satisfied. Ideally you have to apply which method? ACM. But if you want, you can still apply FETPL. Ideally you have to apply ACM, but if you want, you can choose to apply FETPL. B plus D you passed. Ideally you have to apply FET-OCI, but if you want, you still have a choice of applying FETPL. FETPL is a methodology that can be applied for any financial asset. This generally people do not discuss, because if this point is known to you, you will take this route while doing examination questions. That's why nobody tells you, but this is there in part of India's 109. FETPL ka advantage is, sir, always the asset is appearing at fair value in the balance sheet. All transaction costs are thrown off into P&L account. Any interest income, interest expense also recognized in PRL account. So everything is recorded in PRL, and asset is also appearing at fair value. So thereafter, you not following EIR, that and all are treated as minor discrepancies that are ignored. That means in a way, overall whatever income you are making, that is coming in PRL, and ultimately fair value fluctuations also will come into PRL. Asset in the balance sheet is appearing at fair value. So FETPL is a kind of a general method which can be applied for any financial asset, but this is not something you will apply while doing exams. Exams low, always whatever is applicable, that method only you have to apply. Don't take this general route, but this standardly option is there. Next, there are some note points after this, sir. These note points yesterday we haven't discussed except for 1 or 2 points. Note points are important, sir. Important in the sense, while solving main big questions, you will not require these, but on every small point there is a question, theoretical question, never came in the exam till now. But there are too many questions, like 8 or 9 questions are there only on business model and contractual cash flow test. Small theory questions. So those theory questions you may get time to prepare, may not get time to prepare, but if you understand these points, if at all that question comes, you can definitely answer. 100% correct answer will come. So it's a summary of all the questions which are theoretical basically. Note points is that. Anyway, what is this case is, sir, suppose A Limited is there. A Limited purchased an investment in bond which has a life of 5 years, a maturity period of 5 years. A Limited said that, sir, it is our business model to hold it till maturity. And imagine that SPPA test also passed. So they want to apply which method now? ACM method. Now, immediately, auditor comes during the course of verification. He comes and tells reports to A Limited that A Limited, few years back also you purchased one investment. At the time also you told that investment you are going to hold till maturity. But that investment you did not hold till maturity. You have sold off before the maturity date. But today you purchased a similar investment. Again you are saying that you will hold till maturity and you want to apply which method? ACM. But in the past history, when I see couple of instances, you have sold off the investments which are measured at ACM, but you have sold them before the maturity date. Now how can I trust you that investment you are going to hold till maturity? Auditor asks you that, why are you calling it as hold to maturity even though you have sold similar investments in the past before the maturity date? Therefore, ideally you should not apply ACM. You must be applying either FET OCI or FETPL, and ultimately fair value fluctuations have to be recognized in your books of accounts. This is auditor observation. Idea is correct only, no sir, because if you say that today you bought an investment, you want to apply ACM because this is your objective, I will look at your past history. Past, sir, there are a couple of cases where you sold off the investment before the maturity date. You sold off the investment before the maturity date. Therefore, I can't trust you is what auditor says. For that, the standard says consider these points also. There is no violation of business model that is held to maturity if financial asset is sold for want of funds. This is referred in the standard as a stress case scenario. What is the meaning of want of funds is, for example, sir, I have surplus money, I invested in bond life is 5 years. I thought that I will hold the bond till the next 5 years. I will only receive the maturity value, I will never sell the bond. But after 3 years, I am in a liquidity crisis in my entity. I urgently needed money. Okay, and borrowing I can make outside, but the interest rate is very, very high. Now in front of me, two options are there. Option number one, borrow at a very high exorbitant rate in the market, or you have an investment, no, sell off the investment and use the money. What I did is I sold off the investment and I used the money for whatever purpose I need. Standard says, if you are in a situation of you need money, in that case if you sell the investment, that is not a violation of held to maturity business model. You can still continue to apply ACM for future investments. Investment anyway sold, no, for this you cannot apply any ACM. Investment is derecognized hereafter. So because the auditor told, no, in the past you sold, past why did I sell? Because I am in urgent need of money, I sold. Standard says that is not a violation of your ACM objective. You can continue to go ahead with ACM. At one case. Second case is credit risk of investee has increased beyond acceptable level. What is the meaning of credit risk increasing is, look at this, mom. A Limited invested money in R Limited, a bond. Bond means debenture investment. When I invested money in R Limited bond, I saw that at this date, credit rating of R Limited was single A or double A, let's say. Credit rating means it is a independent opinion given by credit rating agencies regarding the creditworthiness of the borrower and their intention and ability to honor the debt obligations. This credit rating, like how an auditor gives you true and fair view opinion on financial statements, like that a credit rating agency gives an opinion on ability and intention of the entity borrower to repay the debt on time. Looking at that rating, investor who gives money to the company or investor who lends money to the company, he will understand how risky the company is. If it is more risky, we will expect more interest rate. Less risky, less interest rate, like that. That is the purpose of credit rating. Suppose looking at this credit rating AA, A Limited invested in R Limited. Now, life of the bond is 5 years. I thought that I will hold the bond for entire 5 years. After 2 years, I came to know that R Limited is suffering huge losses, very huge losses, and within 1 year R Limited will be liquidated. Now, tell me, sir, will you still stay in the company like a stupid? No. You thought that I will stay in the company for a period of 5 years, but if I stay for one more day extra, for every 1 day I stay there, my money is losing. I'm not a stupid to stay there. No, I sold off my share and or sold off my bonds and I have come off out of the investment. This is not a violation of hold to maturity objective. Your goal is hold to maturity only. I want to hold also, but the risk of the company where I invested, our risk is significantly increasing. Will I, like a stupid, will I still stay there only, sir? Definitely I will sell off my share and come off. No, that's exactly what I have done. Standard says this is not a violation of your objective. Here after new investments you buy, happily you can call yourself as held to maturity. This is not a violation. Second case. Third case. Imagine, sir, you are a bank. If you remember your C enter ka basic somewhere, banking chapter, in case you have studied properly, bank investments can be in 3 categories: held to maturity investments, available for sale, held for trade, and 3 categories. So a bank can have investments. Now, bank's money, whatever bank is investing, our money actually belongs to whom? Depositors' money. Correct, no, sir? Whenever they ask back, the bank should be in a position to repay the money back. But bank is not stupid to hold idle funds. No, so they are definitely going to give it as loans to people. Still surplus money is there that they are going to invest somewhere. What RBI guidelines, Banking Regulation Act all put together tell you is, you cannot have held to maturity investments more than 25% of your total investments. If your overall investments is 100 crores, held to maturity and a long-term investment cannot be more than 25 crores. Why? If you invest all your money in long-term investments, tomorrow a depositor comes and asks money, how will you withdraw that? It is difficult. So keep money in short-term investments or held for trading investments. That is what RBI ka guidelines is for bank. Now what you did is, your overall investment is 100 crores. Maximum permitted under held to maturity category is 25 crores. 25 crores you invested. Full limit you used of 25 crores. RBI is not satisfied there. What he says is, 25 crores rupees you invested in held to maturity investments. You are saying that e-bonds you will hold till the maturity date of the bond life. RBI says every year do something and demonstrate liquidity. What is the meaning of liquidity? How quickly you can convert something into cash is called as liquidity test. So demonstrating liquidity, how will you demonstrate liquidity? There is only one way, no? What is that? Sell it off. I am having how much investment? 25 crores. What this bank did is, at the end of each year, they are selling 10,000 rupees worth of investments. Why are they selling? To book profit? No, not for booking profit. To see how quickly the investment is getting converted into cash. That is the objective of selling the investment. Now, you cannot say that, sir, you sold off some investments before maturity date. This is a violation of your held to maturity objective, and you cannot say, because here I sold true, but why did I sell? I am selling a very, very insignificant portion of my investment just to see how quickly this is getting converted into cash. For that purpose, if I sell, that is still not a violation of held to maturity objective. To demonstrate liquidity, insignificant investments are sold. That is not a problem. In 3 cases low, even though you sold the investments before the maturity date, you are still treated as having a business model of holding the financial asset till the maturity. And happily you can apply your ACM method. That's the logic behind this. These three are big story questions, but ultimately matter is only this much. Then further concepts. Come to point number 4. Or not point number 4, point number 5 please. A conceptually very important point. In point number D, when you told that your cash flow should solely represent principal payment and interest. Now what is interest is not what is recorded as interest in the contract. I don't care what you wrote in your contract. Interest means interest as defined under the standard. Now how the standard is defining interest? See there. Interest is the consideration that should represent time value of money plus an additional return for covering the risk. So our additional return is how much? Additional return depends on how risky the borrower is. The interest rate can be linked to inflation rate also. Interest rate can be fixed rate also, floating rate also. It can be anything also. But it should represent two things. Now indirectly, if I should put it very easily, people who have done your AFM must understand, others can relate also. Sir, in AFM subject, you have bond ka valuation chapter, you have share ka valuation chapter, then you have derivative ka valuation chapter, then you have business ka valuation chapter. The entire AFM will be doing valuation of so many things. You take, or in fact capital budgeting project ka valuations also will be there. You take any chapter, for getting the valuation you will need a discounting rate. The discounting rate is always called as required return. Required return means how much you want. Sir, I want 45%, sir. Not what is your inside feeling, not that. A required return one methodology is there. Required return is your basic risk-free return anyway you should get. Just because you invested money, just for breathing and being alive, you want risk-free return. That is minimum. But the place where I invested is risky. That's not government of India, no, to give me just risk-free return. If I invest money in RBI, I'll be happy with 4.5%. But I'm not investing in RBI. I'm investing in some other company ka bond or some other company ka share or in some project or somewhere. So anywhere else you invest, you want some extra return. The extra return is actually called as risk premium. It is the premium and a word meaning is extra return I want for the extra risk what I have taken. This is called as required return. Required return is interest, means your return should be this much. This is your interest definition as per Ind AS 109. Yesterday I told you one case of somebody issued a convertible bond. Somebody gave a convertible bond. A bond compulsorily will be converted into equity shares at the end of 5 years. But for the next 5 years, I will be receiving 10%, 10%, 10%, 10%, 10%. But in all convertible bonds, safely you can confidently assume that our company ka required return will be 13%, but coupon will be only 10%. He will always pay you lesser interest compared to the market rate. Still you are buying. Why? What is our feeling is whatever interest we forego each year, that we will recover in the form of excess value of shares received at the end of maturity date. And a feeling the people will pay. So every year, sir, I am receiving interest. No, sir, you are receiving interest, but that interest is not interest according to Ind AS 109. Therefore, CCFT test will fail there in that case. So what our standard defines is interest only if you receive this much. You don't receive this, then what you are receiving is not interest. Since what you are receiving is not interest, at D point happily you will fail off. Once a D point fails off, you have only one method, which is FVTPL. That's why all convertible bonds, optionally convertible bonds, they all will fail the test of SPPA or CCFT test basically. This is the logic of that. A point again I have given here. The cash flows arising from financial asset should be in the nature of interest and principal to meet the cash flow CCFT test. If the financial asset involves rights of conversion into equity shares, then CCFT is not passed. Will fail that test. Then, look, you tell me, sir, this case. Reliance Industries Limited is there. Required return is 14%. What is the meaning of required return? If anybody gives money to RIL, they should demand a return of 14%. If they offer 10%, 5% or not, I should not give them money, basically. That's the meaning of that. Now, this RIL fellow issued one bond, 100 crore. This fellow is the investor. He gave this money. Okay. But he bonds some return, he should get know that return is RIL tells this fellow that Baba, I will pay you 2% of my profit as interest. Tell me this, is CCFT test passed or failed? They will pay whatever profit they earn into 2%, they will pay you as interest. CCFT test passed or failed? Failed. Why is it failed? Sir, that fellow's profit lo 2%, will it be equal to 100 into 14%, 14? Will it be compulsory equal? No, it may be equal, may not be equal. In fact, I may not get anything also. If he suffers a loss, will he pay me anything then? No. But I still need my compensation for time value of money. I still need compensation for the risk taken for giving money to that fellow. Where is that? You are not getting. E-test is failed. Interest that is linked to profit of the borrower is a violation of D point, which is your CCFT test. D point fail, FETPL is the only method you have a choice to apply. You can't apply any other method. Sir, why are you so strict with this? Sir, not strict, sir. The point here is, if what you are receiving every year, if it does not satisfy the definition of interest, with what phase will you go and apply EIR? EIR is nothing but IRR. IRR can be applied only when cash flows are fixed. If your stupid cash flow is changing every year because that is linked to the profit of the borrower, how can I work out EIR? EIR is applied in which method? ACM lo applied, FETOCL lo applied. So obviously two methods you cannot apply. No, the only choice you have now is FETPL. That's exactly what we are saying. If you observe closely and think, it will be very easy. Anyway. Last point, last question. This is on this theory part. It is called as the story of securitization. This is A1 theory chapter, sir. Easy only. If you have already known this, it's okay. See, internal also it is there, I know. But anyway, listen here. Sir, you are HDFC Bank. What is your major asset? Land and building, plant and machinery. Then what? Loans. Loans given is your major asset. These people, they took loan from you and they bought houses. Tell me, sir, loans which are given for housing purposes, long-term loans or short-term loans? Long-term. In fact, very long-term loans, isn't it, sir? Now, this fellow took money from public in the form of deposits and all. That money he gave to these people for buying or building their houses. And this money is not going to come back for the next 25 years, isn't it? That means the money is blocked. Now HDFC Bank, if they want to give a new loan, they need cash. Whatever cash they have, predominantly they are lent, and that money is not coming easily back because it will take a lot of time to come back. They again need money. What they do is, HDFC itself creates another company which we refer it as a special purpose vehicle. It's just called as an SPV. Just understand it's a separate trust or separate limited company. What this SPV does is, this SPV buys the loans from HDFC Bank and it pays cash to HDFC Bank. So cash will come here, loan receivables are transferred to SPV. Now sir, how can a newly formed company pay cash to us? Now in the market, sir, there are some entities which are cash rich. It means lot of cash is there with some companies. Sir, who, sir? Insurance companies. Every day lakhs of people keep on paying premiums to them. Lot of cash is there with them. That cash they can't hold idle cash, so somewhere they have to invest. They can invest in bank also, but bank will give you only a return of 6% or 7%. So what they are looking for something higher return. At the same time, they don't want to take very, very high risk also. But lot of money is there with this fellow. Similarly, mutual funds. Lot of people buy investments, invest in mutual funds. In mutual funds, sir, no matter how much risk they want to take, they don't want to lose the entire money by investing in risky assets. Some portion of the money they park in safe assets. So that money is there with them. Then pension funds, provident funds. Every month out of your salary 12%, 13% some amount goes to the government. A PF authority will have lot of cash each month. They have to invest somewhere, no? Cash rich people will give money here first. This money, SPV passes it on to HDFC Bank, and HDFC Bank transfers the loans to SPV. These people who gave money to SPV, they are allotted bonds here. So this is a drama of securitization. So securitization, what happens is, okay, illiquid asset called as a loan receivable is sold to another company. Another company is also mine only. I only formed that another company will raise cash in the market by issuing debt securities. Our cash is given to our bank loan receivables are transferred to SPV. And the securitization deal. Is the basic clear? Yeah. Now look at the accounting part. HDFC Bank is the original fellow who gives the loan. He is called as originator. Correct? Now, whenever I give loan, tell me, sir, will I hold and collect the cash flows till maturity, or I am selling it? At the time of giving loan to a customer only, I know that a loan receivable is going to be sold. Since my prima facie objective is to sell financial assets, what is my business model? What is my business model, sir? My prima facie objective is to sell financial assets. What is my business model? To trade. And which method I have to apply? FATPL. So, HDFC Bank, they will apply FATPL. As long as the loan receivables are appearing in their balance sheet, they have to apply FATPL method for accounting that. Imagine loan receivables are transferred to SPV. Now loan receivable is whose asset? SPV ka asset. Now what will SPV do with this asset? They will hold. All these fellows who bought or built houses with your money, hereafter they will pay interest and principal cash flows to whom? SPV. So what is SPV ka objective? Holding till maturity. So SPV point of view, the objective is holding till maturity. Therefore that fellow has to apply ACM. Before sale, parent company books FATPL. After sale, subsidiary company books ACM. I don't understand, because the business model is different. Now, before sale, HDFC consolidated financial statements. So what will you apply? Before sale, HDFC consolidated financial statements. So what will you apply? HDFC standalone, you applied what? FATPL. Why? Because HDFC objective is to sell the financial assets. But consolidated financial statements are also prepared by HDFC only. But consolidation is done not just for HDFC, it is done for holding company plus subsidiaries also. You have to treat me and my subsidiaries together as a single entity. Actually, how many entities are there? 2. But consolidation point of view, it is as good as there is only one entity, one large entity, HDFC group. Tell me, sir, is the group going to sell the financial assets? Is a group as a whole going to sell the financial assets? No. HDFC will sell to SPV, but SPV is who? He is also part of our group only. No, that fellow is he going to sell? No. So group point of view objective is still holding till maturity. So here also you will apply. So if you broadly observe, before sale, HDFC standalone financial statements FATPL. After sale, SPV standalone financial statements ACM. Before sale, consolidated financial statements of HDFC group ACM. Because group point of view will never sell the financial assets. They are within us only. Are you understanding, sir? Suppose this is not SPV. You normally sell it to any random fellow and collect cash immediately from him. In that case, purely FETL. Group, that fellow is not part of your group anyway, so the discussion will not arise. That is for some other subject. What are asking me, securitization ka logic, no? Because they want money, no? Then they will not sell. No, sir. Sir, he is asking whether securitization compulsorily banks will do. No. No. Only when they are doing, then why will they unnecessarily do? See, sir, what happens is, sir, every industrial competition is there. Banking industrial also competition is there. So, if my bank is in a leading form, lot of depositors are coming into my bank, so I will be having lot of cash. I am not in a position or I am not in a need to do for a securitization transaction. But imagine there is a public sector bank or an old private sector bank which has lost its charm in the recent years. The fellow is not getting much of deposits. But there are always people in the market who want money. So I can give money to him, earn interest and make profit. But to do that, I should need money. That much of inflow of deposits is not there. Those people will do this kind of things. It's not that every bank does, and it's not compulsory, it's just a model. Anyway, this is done. Sir, this table is a summary of how to apply ACM, FET-OCA, FET-PL. FET-OCA, I have given two columns. One is for equity investments, one is for debt investments. See, are all the columns correct or any mistake is there? Go through the table. If any mistake is there, let me know. Initial recognition ACM low, fair value with transaction cost, correct only. FET-OCA also same to same. FET-PL only fair value, transaction cost will be recorded in PRL. Unrealized gain or loss. First category, no fair valuation. FET-OCA bond investments, OCI, and it is reclassifiable. FET-OCA equity investments, non-reclassifiable. Did we discuss this yesterday? Yes. FET-PL directly PRL ke go. Interest and dividend. ACM method lo EIR you will apply. FET-OCA also you should apply EIR only. FET-OCA equity share ki dividend directly will go into PRL. EIR and all you cannot apply there obviously. FET-PL ki anyway PRL. Realized gain or loss. Everywhere it will go to PRL. Everywhere it is realized gain or loss will go to PRL. In third column, no, sir, retained earnings what I wrote is OCA ka reserve is, since it is not reclassifiable, directly have to merge it into retained earnings. But gain or loss on sale has to be transferred to PRL. That point also right. Gain or loss on sale transferred to PRL. Accumulated OCA reserve should be merged into retained earnings because reclassification is not permitted there. Normal gain or loss on sale should be thrown off into PRL. If you observe one thing here, there is one point which is coming into this table from Ind AS 32. What is Ind AS 32? Presentation standard. Yesterday we did. What that fellow told is interest and dividend should be recognized in PRL. Brackets are wherever PRL is there, that's not coming from Ind AS 109 for interest and dividend income. It's coming from Ind AS 32. Ind AS 32 told what is the destination of interest and dividend, but how much is your interest, how to measure, EIR, direct amount, adi 109 tells you. Accounting is given there, measurement is given in 109, so mix it like that. Okay, let me directly tell you the confusing point. FET-OCA means, sir, fair value fluctuations you will put it in OCA section. Interest income will still go into PRL only. Fair value through OCA means fair value changes OCA lo. Interest income is a realized gain that will go to PRL. Gain or loss on sale also will go to PRL. OCA ka reserve will be reclassified if it is investment other than equity. Equity investment is the reclassification not allowed. That's all. There's something called as day one difference, which I'll explain with an example. Now come to special cases, sir. All these special cases are there. They are important only. In that, one or two are extremely important. For instance, this one. ICA is not tired, even though they have asked this many times in the exam. Staff loan case. Sir, X Limited is there. It gave a loan to employee 1 lakh rupees at the rate of 2% per annum for 3 years. Market interest rate is 10% per annum. So 0, 1, 2, 3. Today we gave an amount of 1 lakh to our employee. Sir, when market interest rate is 10%, why did we give loan only at 2%? Why? Because he is my employee. If he is some roadside fellow, why will I give, sir? He is because my employee only, I gave it at 2%. So for the next 3 years, what cash flows will you receive? 2000 and 2000 and 1 lakh 2000. Correct? Now, tell me, sir, what is the entity's objective with this? Are we going to sell the loan and all? No. We are going to collect cash flows from the employee. Ideal method what you have to apply is ACM only. What is the entry you write to tell me when loan is given normally? Loan given, account debit to bank. What is the initial recognition principle under ACM? Initial recognition principle, ACM. Fair value adjusted with the transaction cost. Example, transaction costs are not there. So I have to record the loan receivable at fair value only. What is the fair value? This 1 lakh is the transaction value. Today I paid 1 lakh, but this is not the fair value. Sir, how will I know the fair value? Simple, sir. Take this employee, hold him, take to the bank. Tell the bank that, bank, I will pay you 2000 first year loan, 2000 second year loan, third year I will pay 1 lakh 2000. Today how much loan will you give me? I'm going to ask bank. Bank will expect how much return? 10%. Considering that, how much loan this fellow deserves for the cash flows what he is paying us, calculate that. That is the fair value. Always a loan ki, bond ki, fair value is nothing but present value of future cash flows discounted at market interest rate. That is fair value. So what you do is, e-cash flows discounted to today. 2000 into PV IFA annuity factor 10% 3 periods. 1 lakh rupees only once I am receiving, so I will apply a PV factor 10% third period. So if you work out this, how much did you get my 80? 80105. 80105. Ideally, for the cash inflows what the employee is paying to the company, our company should give him only an amount of 80,105. But looking at his face, because he is our employee, I paid him 1 lakh. How much extra did I pay? 19,895. This is extra amount paid. Now, what is the accounting for this? Accounting is very simple, sir. Look at this. Staff loan account debit. Fair value I should record the ACM. To bank. What I am paying is 1 lakh. E gap whatever is coming 19,895, which is a balancing figure here, which is basically a kind of benefit what the company has given to the employee. E accounting, sir, it depends now. Definitely, very clearly, company has given freely an amount of 19,895 to the employee. The employee cost, it has to come to P&L account basically. But when will it come? Because loan period is how many years? 3 years. Generally, sir, generally, when I give a loan to you for a period of 3 years, what is the prima facie condition I put? For the next 3 years, you should be in our employment only. Correct? No, it's not like today I give loan to you, tomorrow morning you resign and join some other company, and I keep on collecting like a stupid 2000 rupees from you. Will it be that case? No. Generally, when a concessional interest rate loan is given to the employee, usually this condition will be there that employee should continue to work for our office in the next 3 years also. That means money is not freely given. Money is the cost what you are paying to the employee to retain him in the company for another 3 years. So next 3 years he will stay here, give you services. For that you are paying today 19,895. Benefit is going to come in the next 3 years. Therefore, we usually debit this to a prepaid expense, which we call it as prepaid staff cost. If the question tells you that, which generally it won't, but in case the question tells you that, sir, there is no condition like that to the employee. We have given loan to him, concession interest rate loan, based on the services what he already gave us in the past. I don't expect him to continue his service. If he stays, that's okay. Even if he does not stay also, we don't mind, we'll still give loan. In that case, you are not expecting any benefit from the employee in future. Sir, why sir? Benefits already received in the past. So in that case, this has to be thrown off to PRL right now. In that case, I will use the word staff cost. This is debited to PRL immediately. You have to watch the question, sir, and then accordingly decide. For this case, this is amortized to PRL over loan period in straight line method. Which one will you do depends on question data. And since I have seen all the questions that are there in your StudyMat RTP exam till now, either they will tell you that there is a condition or the question is silent. Just because question is silent, don't assume this. Always assume this only. All the answers given in your ICS study material are only prepaid staff cost cases. You also assume like that even if the question is silent. But staff cost, entire amount throwing it off to PRL on a case is possible, sir. India's 109, it's very clearly there. Once upon a time, CA Institute exams also it has asked, but that's not under India's ka zamana. So that's why examples I did not keep. Whatever today in this curriculum, prepaid staff cost is what you will do if the question is silent. When you will amortize it off to P&L account every year, it won't be there. 3 years lo amortize chestam. Sir, prepaid staff cost ane daniki logic endante, sir, you are giving a benefit to the employee, and for the benefit what you have given to the employee, you put some conditions. Generally the condition is make him work for some more period. So for working that extra period, you are giving an extra benefit to him. So 19,895 should be amortized over such period basically. So that's the general logic there. Sir, hereafter what will happen? Hereafter, on this you will go and apply ACM. ACM application means what? Initial recognition already over. Hereafter, every year interest income you have to record according to EIR, and whatever cash flows he is given, record that. Like that, if you go on recording for a period of 3 years, your loan account automatically will become 0. A staff cost either directly PRL, prepaid staff cost either you will amortize it to PRL over a period of 3 years in this example. Like this it works, sir. This is the basic version of staff loan. In this only one adjustment is there. That adjustment I will directly show you while doing the question. We will directly take up the biggest question we have on staff loan. There are other questions also. They are solved. They are cheap, sir. They are less dangerous. Biggest question what we have that we will take and we will solve that. In that only one good adjustment is also there. What is the page number of instrument, sir? 13 point? Okay. Go to question number 150, 120, 150, 120, 130, arrange somewhere. still is 84. Sir, once instruments is over, I'll give you a list of questions which are the bare minimum questions you have to prepare. Worst scenario. Okay, ideally I will never give important. Now also I'm not giving you important because there are 150 plus questions. Sometimes one panic kind of situation can arise. So 20 questions or something like that I'll give you. Worst case, 20 questions if you prepare and go also, you are safe for the exam. Concept completely. Questions practice 20, that's enough. That is, once we cover everything, then I will tell you. But ideally, you should prepare everything. Embedded derivative, not yet, not yet, not you, not you, not you, not you, not you also. Coming. Question number 120, yeah. Oh, yeah. You. Question number 155, please. Read. Wheel Company Limited has a policy of providing subsidized loans to its employees for the purpose of buying or building houses. Mr. X, who is executive assistant to the CEO of Wheel Company Limited, took a loan from the company on the following terms. Principal amount 10 lakhs, interest rate 4% for the first 4 lakhs and 7% for the next 6 lakhs. See this fellow's sadism. Out of 10 lakh rupees, he is breaking the principal into two principals. One 4 lakh principal, one 6 lakh principal. If 4 lakh, you will have to apply 4% interest, and on this you have to apply 7% interest. Starting date is given 1st Jan 20x1. Life is 5 years. Prepayment can be done anytime at the option of the employee. The principal amount of the loan shall be recovered in 5 equal annual installments. Underline this word. Principal is recovered in 5 equal annual installments. That means your principal amount is 2 lakhs per annum. When the employee pays 2 lakhs, which principal is deemed to get over firstly it seems and will be first applied to 7% interest bearing principal. Our company gave loan to an employee 10 lakhs. E loan lo there are two principals, one 4 lakh principal, one 6 lakh principal. When the employee gives us first 2 lakhs, I will feel that he has paid me a portion of 6 lakhs. Thereafter another 2 lakhs, thereafter another 2 lakhs. This gets over. Last 2 installments are relating to this 4 lakhs principal. That's how you have to understand. The accrued interest also shall be paid on annual basis. So every year apart from 2 lakhs, extra also you have to pay interest. And then outrightly he is telling that you must remain in the service. So that gap whatever comes will be adjusted into prepaid staff cost. The market rate of a comparable loan available to Mr. X is 12% per annum. If Mr. X goes to the market, he can raise money only at the rate of 12%. We are at least giving at 4 and 7%. The following table shows the contractually expected cash flows from the loan given to Mr. X. You need not even work out the loan cash flows. That fellow only has given. Today, 10 lakhs you gave. Every year that boy will pay 2 lakhs principal. First year interest also has to pay. All of you take your calculator, work out and measure the math. Sir, first year 2 lakhs, when did he pay us? End of first year. That throughout the year, how much is outstanding? Entire 10 lakhs is outstanding. On the 10 lakhs, how much interest we have to pay? 4 lakhs means 4%. 6 lakhs means 7%. 6 lakhs means 7% is 42,000. 4 lakhs ka 4% is 16,000. 42 plus 16, 58,000. So 42, 16. First year ending, he pays off one principal component of 2 lakhs. So hereafter your remaining principal outstanding is 8 lakhs. In this 8 lakhs, our original 4 lakhs at 4% is anyway there. Our 6 lakhs now became 4 lakhs. On that interest has to be computed at the rate of 7%. So next year interest is how much? 4 lakhs into 7%, 28,000. Plus the remaining 4 lakhs into 4%, 16,000. So 28 plus 16, 42,000. all that you need not do, that fellow has given. You should just understand how they have computed, that's enough. Like that, for next 5 years if you pay, happily the loan amount will be over. Mr. Yes prepays the loan, something is telling, let's do one thing. A prepayment and all happened at the second year. So first what happened or what is to be done on the very first day, let's try to work out that. Come to your notes, sir. Question number 155. So first and foremost, you have to work out the fair valuation of the loan receivable. Why should I work out the fair value? In ACM, initial recognition is at fair value plus transaction cost. So I definitely need fair value. Normally bond ki, share ki fair value ante market value. But this is not a bond. This is not a equity share. What is this? Loan given. Loan given is traded in the market. Stock market, like, can I go and bring the value of this? No. So loan receivables ki, loan payables ki fair value is nothing but present value of future cash flows discounted at interest rate ki you go to the market and bring. Okay, so just as a principle, if you want, you can write this present value of future cash flows at market rate or market interest rate. Let it be loan receivable, loan payable. Ide technique. So here cash flows, PV factor or discounting factor is given at what rate? 12%. And present value of cash flows or discounted cash flows. First year, already they gave, sir, you just total it up. 2,58,000 first year. Second year 2,42,000. Sorry, 44. Right. 230, yeah. 216 and 2,8,000. In the next 5 years ka loan cash flows, installments including interest. PV factors. You can see normally if the question gives you any PV factors, use that only. Why questions give PV factors is not because you don't know. They want a uniform answer for everybody. Correction will be easy for them. For that purpose they'll give you. And sometimes when you use that PV factors only, round numbers will come. Okay, so when question gives you PV factors, use that. If question does not give, so you compute your own PV factors. Generally 4 digits is best. 711,863,55,56. Do this math. Tell me this total. 8 lakh 40. 88. 6. Okay. This is present value and this is also the fair value of staff loan. This is what ideally you should give, but what you gave is 10 lakhs. You extra gave some amount that will go into prepaid staff cost account. If this number does not match with whatever they have printed in the solution, that's because of PV factors. That's okay, sir. That is not to be worried. Sir, till here I don't think you have a doubt. Okay. Now the entry what you should pass on the very first day is 1st January 20x1. Staff loan only at fair value, which is 843,886. Since we are asking him to stay in the company, definitely this gap must be transferred to prepaid staff cost to bank. How much am I paying? 10 lakhs to that fellow. So work out this, 151, 156, 114. It already solved solution, sir. If you don't write also, it's okay. If you write also, it's fantastic. Now, hereafter, sir, on this staff loan, all you have to do is just apply ACM. It is straight line method, just amortize it to P&L account. Like that you have to do for how many years? Next to 5 years. Katama loan account will become 0. But this fellow gave a twist that somewhere after 2 years, he did one extra payment, prepayment he did. What is to be done at the time of prepayment, we will see when we go there. So first let's do accounting for how many years? It was 2 years. Because prepayment happened at the end of second year. Up to second year, normally you do. Prepayment how to do, we will see at that time. It's a very cheap adjustment, sir. I can tell you now also how to do, but I don't want you to think also because it's that cheap. So, that much patience we don't have. Right. If you are writing exam load, don't do this model. You will unnecessarily lose marks. I'm warning you before only. Monday exam, you only told and you should not ask me. At the end of each year, what is the balance sheet date here? December, huh? Okay. 31st December X1, 31st December X2, 31st December X3, 31st December X4. Ideally, the smart versions are exam low. If I am the valuer, you do this, I'll give 1 mark extra also for doing this. But they will say, you are not writing imposition, sir. As real life, you will not write entry. A system will write. The labor work, no, sir. They are expecting you to write every year 4 entries like that for 4 years means 16 entries you have to write. Extra modification or some modification is there here. For that 1 or 2 entries extra. Hands will pain, sir. Okay, anyway, let's first focus. Every year, what accounting we have to do? Under ACM, you have to recognize interest income. You have to receive contractual cash flows. Sir, nothing else. Now look at this. What is the entry for interest income? Bank to interest. Those days are over. In our life, those days are over. Bank to interest and a day is over. What is the entry? Financial asset account debit to interest income. So the entry what you should write is staff loan account debit to interest income. Sir, how much is first year interest income? I think at brackets somewhere we'll calculate, not a problem. Okay, next. B point. Interest income will throw off into P&L account. Very good, sir. Staff who took loan from us, he will pay some amount. Contractual cash flow received. Bank to staff loan. Then, whatever staff prepaid staff cost and you wrote, that you will have to amortize it to PRL. So, this is amortization. What is the amount of prepaid staff cost you told me? 156,114 divided by 5 what, sir? Please tell me the number. 31,223. Then D point is or simply balance in staff loan account. This is not entry, just a number. These 4 items if you record for each year, drama over. Tell me, sir, staff loan ke first year ke interest calculation you want. How to compute? On which amount? 843, 886 into 12%. How much did you get? 102, 101266. Okay, nice. This went off to P&L account. The moment you credit interest income, this is the number that goes to PRL. Bank to staff loan. Our boy pays us in the first year 2,58,000. Amortization anyway we wrote off. Second year also same amount only. Don't disturb third year and fourth year. Later on we'll see. So staff loan ka balance at the end of first year. Why are we interested in that? If you don't know closing balance of financial asset of first year, second year on what amount will you calculate interest cost? Work out and tell me. 843, 886 opening balance plus 101, 266 minus 258,000. 1, 2. On this 687, 152, apply 12% to get second year ka interest income. 82,458. Second year our boy is giving us 2,44,000. Prepayment he did, don't even worry about that. Later on we'll see. 244. What's the balance now? After this normal payment. 600. 610. Okay. Now read the remaining question if you have copied this. Somebody is doing this. Read the remaining part of the question. Up to here, normal thing happened, sir. Now this fellow did some extra drama. A drama ka accounting you have to do. Let's see the question now. What did he say? Mr. S prepays 2 lakh rupees on 31st December 2002, which is second year ending. Second year ka installment he anyway paid. The extra prepayment. And therefore reducing the principal balance at the date to 4 lakhs. Normally 10 lakhs loan low, first year, second year 2 lakhs. If you pay, outstanding principal should be 6 lakhs. But because of this prepayment of another 2 lakhs, effectively principal became only 4 lakhs. The following table shows the actual cash flows from the loan given to Mr. X considering the prepayment event on 31st December 2002. Now that prepayment happened, 5-year installment loan has now become a 4-year installment loan. First year, second year he paid. Second year prepayment he did. Remaining 4 lakhs is there that he will pay in third year and fourth year. Entire revised cash flows they are giving. First low you gave 10 lakhs. First year he gave 2 lakhs. Second year he gave you 4 lakhs. Third year lo another 2 lakhs he will give. Fourth year lo another 2 lakhs will give. And in the fifth year you don't have anything to receive. Your loan account gets closed at the end of fourth year itself. Even though loan was originally for a period of 5 years, because of a prepayment, loan has turned to be only 4 years loan. He asks you prepare journal entries for all the 5 years. So for first you should know how to do accounting for this prepayment. You will not write anything. Watch. If somebody is writing, you can copy at once. Second year, what is the carrying amount of your loan balance after writing normal installment 525.16? Each stage, what did this fellow do? Prepayment. So on 31st December 2000x2, prepayment received. You don't have a choice. You have to debit bank account. How much did he pay? 2 lakhs. Go credit this to your staff loan account normally as usual. 2 lakhs. After this, the carrying amount of staff loan account will be 3,25,016. Tell me, ma'am, this 2 lakh rupees extra whatever he paid now, is it within the plan unexpected? Unexpected. That means your original estimated cash flow timings have changed. Original cash flow timing was what? First year 2 lakhs, second year 2 lakhs, third year, fourth year, fifth year, every year 2 lakhs. But now second year only you are getting an amount of 4 lakhs. Because of that, your cash flow timings and series have got disturbed. Whenever cash flow payments and schedule gets disturbed, sir, ACM will not work. Why ACM will not work is, ACM ka closing balance should always represent the present value of future cash flows. The moment if you delay any payment or you pay anything early or you don't pay at all, then what will happen is cash flow ka schedule got disturbed. When cash flow ka schedule gets disturbed, ACM will fail. ACM will not work. For one moment if you hold, imagine that if prepayment is not there, then what is the carrying amount of your loan? If you want to patiently sit and work out, if 525.16 will represent the present value of 2 lakhs, 2 lakhs, 2 lakhs along with interest for the next 3 years discounted at the rate of 12%. Definitely it will match, 100% it will match. If that does not match, ACM will not work. Ultimately loan amount will not become 0 on the last day. But now what happened? 2 lakhs which are ideally supposed to receive after 1 year, that you are receiving today only, and this also gets preponed, this also gets preponed. Because of that your schedule of cash flow got disturbed. ACM will fail. Sir, then what to do, sir? What to do? Nothing. All you have to do is just to remeasure the loan. Remeasure the staff loan. In what way? To reflect the present value of future cash inflows. Discounted at what rate? Original EIR, sir. Original EIR. You should not go to the market today and bring today's rate. If you go to the market today and bring today's rate, that will become fair value. ACM fair valuation is not allowed. So original EIR only you should take. No fair valuations. Now, what are my remaining cash flows? My remaining cash flows are how many more years? 2 years. This you need not compute. That fellow has given to you nicely. One amount you have to receive on 31st December 20 x3. One amount you have to receive on 31st December 20 x4. But you are already standing at x2 ending. This is 1 year from today. Whereas this is 2 years from today. Why this has to be correctly identified is otherwise PV factors you will get it wrongly. You are already standing at the end of second year. Cash flows will come in third year and in fourth year. That third year and fourth year is 1 year away from you, 2 years away from you. Discounting also should be done only for 1 year and 2 years. Don't apply third year and fourth year ka PV factor. Should be careful. Okay, regarding cash flows, question has given to you already. What will you receive? This, sorry. 2,16,000 and 2,08,000. Only this much you will receive. PV factors. First year PV factor 8929 7972. Total it up. 358. So my staff loan account load today how much balance is there? 325 is there, but 325,610 is not representing the present value of my revised future cash flows. Therefore, I have to restate the staff loan account from 325,610 to 358,673. I have to increase or decrease? Increase. So what is the entry I should write? Staff loan increase. Staff loan is an asset. Asset how to increase? By debiting it. So the entry should be what? Staff loan account debit. With how much amount, ma? 358,673 minus 325,610. 063. Now you should tell me where should I credit this? Where should I credit this? First of all, do you observe that increase in the value of the asset? Is it a gain for us? Staff loan is our asset only, no? Asset balance you are increasing. That is definitely a gain. Normally all gains should be going where? Normally every gain should go to P&L account only. But here the treatment is you should adjust this to your prepaid staff cost. Logic I will tell you. Prepaid staff cost you adjust. Are you having balance in prepaid staff cost? Yes, we have 1,50,000. First year, second year, even though you wrote off 31,000, still around 90,000 balance is there in that. So our 90,000 balance ki adjust of this 33,063. Sir, why should I adjust it to prepaid staff cost? Simple example, sir. Watch here. Suppose this boy, both are our employees only. I gave 1 lakh rupees loan to this fellow at 2%. Ade 1 lakh I also gave to him also at 2%. Market interest rate is 15%. So how much benefit is both these employees getting? 12% differential benefit they are getting. So both of them are getting same benefit, right? Imagine the loan what I gave him is for 3 years. The loan what I gave him is for 20 years. Who is getting more benefit? First boy, second boy? Second boy. Why? Technically speaking, 15% interest rate I am giving only for 2% or 3%. A difference is same for both of them. But the first fellow is taking a loan from me only for a period of 3 years. Second guy is taking for 15 years. The enjoyment of concession interest rate, he is doing it for more period. isn't it, sir? So second employee is getting more benefit. Are you understanding this? Likewise, E particular case lo, sir, I gave loan, concessional interest rate loan for how many years? 5 years. Thinking that I gave a loan for 5 years, the expenditure what I recorded is 1,56,114. But because of prepayment, what happened is the loan ka life ultimately is only 4 years. Mari, when I give loan of only 4 years, the benefit given to employee also is lower only. Therefore, my expense also should be lower. But this 156,114 is recorded with a intention that the loan is given for a period of 5 years. Employee enjoys the benefit for a period of 5 years. But actually loan turns out to be given it only for 4 years. So this much expenditure we should not have. But you already recorded that. So this you go and nullify that expenditure to that extent. That's the logic behind that. Had I recorded entire 156,114 on the first day directly into P&L account on that day, without calling it as a prepaid staff cost, in that case, this also will go to P&L account, right? So very, very obvious point, right? So this is the accounting, sir. If somebody is writing, you can write. The solution is there in ICS study mat also. Presentation, they'll obviously not do very greatly, but yeah. Sir, based on this workout, what is the remaining amount of prepaid staff cost balance? What is the prepaid staff cost ka balance? 156, 114 once upon a time. But first year, second year, you already have amortized something. So balance in prepaid staff cost. 156, 114 minus 31,223, 2 times I am doing, minus 33,063. This will give me amount at the end of second year. 60605. What is the loan life further? 2 more years. So this is to be amortized over year 3 and year 4 at the rate of half it, 302 or 303. This one. Sir, those who have understood this and you are writing this, please fill up third year, fourth year also. If you have not already copied, please copy. The question booklet I have given the answer anyway, but you keep half of answer in your notes. Sir, in this sum, what are the possible mistakes you can do up to now? Where can we mess up? Up to now. Prepaid staff means a prepayment low, you can make a mistake. Where exactly? Put a bank to staff loan mistake, nobody will do. That is too basic. If PV factors, you should be careful, sir. Today means on the day when you are accounting, that is today. When I wrote first entry, I was there at the beginning of year 1, 0 time loan. But now when I am doing prepayment adjustment, I am already standing at the end of second year. So my remaining cash flows are coming across third year and fourth year, which are 1 year and 2 years away from me. That is one thing. E question anyway, there is no other discounting rate, so you will pick up only 12%. But sometimes they will give you market interest rate also, just to confuse you. Don't pick up that. If you use market interest rate, that will become fair value of the loan. ACM loan, you should not do fair value. But you know, first day when you computed this 843, 886, 12% was market interest rate only. First day allowed because initial recognition is at fair value, not every year. So let's fill up the last 2 columns also. Tell me, sir, what is the closing balance of the loan now? this one, you wantedly raised it to 358,673. So on the 358,673 apply 12%. 358,673 into 12%. Entama, how much did you get? 1 again 43,041. Okay, 43,041. Bank to staff loan 2,16,000. Here of course you will pay 2,08,000. This amount you identified as 30,302. This should become nil. What's the closing balance here? 185,714. Last year lo sir, 185,714 you have surely. Into 12% if you do, some amount will come. Don't write that. 185,714 minus 2,08,000 you do. What is the net figure, ma? 22,286. Last year ka interest, it is better you take it as a balancing figure. Even if you directly work out also, nearly it should come off. How much is coming? How much is the gap? 185,714 into 12% if you do, how much are you getting actually? 285. Just 1 rupee gap, huh? If 4 decimals you took, no sir, accurately only it will come. But anyway, for any purpose, take it as balancing. Guess how many marks this came? 16. 16 marks. People who read this, who did this, practice this, a 16 will come into your pocket. Maximum 20-25 minutes, it will be solved. There are other questions also in staff loan. They are not this type, lower than this. Means only loan given, you just have to account it for all the 5 years. Nothing else you have to do. No prepayment, nothing. There is one more case where employee comes and tells the company that, company, I cannot pay money in 3rd year, 4th year, 5th year. I want extension by one year. Means this is a case of prepayment, no? That's a case of postponement. Sir, what should I do, sir? What will you do? Same thing you have to do. See, ultimately, if ACM has to work, the closing balance of the asset should represent the present value of future cash flows. The moment you disturb the schedule, it will not represent anymore. Therefore, disturb the amount also, no, simple. But normally, 525,610, after paying 2 lakhs, it became 325,610. Is 325,610 present value of 216 and 208? No. So what will you do? Update this also to this. Prepayment and postponement. The same thing will happen. A sum why I am not doing with you immediately is in that sum there is a concept of impairment also. So after covering impairment loss on financial asset, I will take you through that sum. Easy only. Now also we can discuss, but after impairment we will discuss. Sir, in this any doubt is there? Pretty straightforward sum. Okay. Now I will tell you one small guidance which is there in India's 109. What they say is, any financial asset, when you recognize this at fair value, but to bank when you wrote E amount, which we are actually calling it as transaction value, if they both are same, then there is no problem. If they both are same, then there is no, for example, market low on the exchange, one share is there, you purchased it that. So your transaction value, fair value, both are same. So in that case, a difference will not arise. But when fair value and transaction value both are not same, definitely you would have paid higher or you would have paid lower. One gap arises. Now what is the treatment of this day one difference? Means this is the language used by the standard. It's called as a day one difference. First day ne difference came in the entry. What is the treatment of this? what our standard says is, you wrote something as fair value there, no? A fair value, how did you get there? A fair value, what is the source? Nick fair value, adi fair value, who told you? For that, various discussions are there. Sir, the quoted market present count, sir. From the market I brought. But ee sum lo, this quoted market price, stock exchange available number, or you calculated? We calculated. What our standard says is, go and check, is it a level 1 input? Level 1 input ka meaning is, simply remember this, quoted market price. If you bring, that is called as level 1 input. Any other case is basically nothing but level 2 and level 3 inputs. In this case, difference transferred to PRL as a gain or loss. In this case, difference is recognized as an asset if appropriate, else transferred to PR. Sir, what is this level 1, level 2, level 3? That I will tell you when we read a standard called as Ind AS 113. Ind AS 113 is about what is fair value. Simple standard only. At the time we will discuss what is level 1, level 2, level 3. Timing, easily understand. Quoted market price if you bring from the market without making any adjustments for that, that is called as level 1 input. Other than quoted market price, you use anything else, that automatically becomes either a level 2 or level 3. Fair valuation, sir, for example, there is a bond, a bond, listed bond. A bond ka fair value I asked. Will you sit and calculate the fair value of the bond? No. Market law already available. Bring that. That is level 1 input. You have another bond. A bond, unlisted bond. You still have to do fair valuation. Sir, but market law price is not there. AFM law you studied, no bond valuation. Apply the technique and do the bond valuation ka calculation. Do fair valuation. But the fair value what you obtained for second bond is not that trustworthy as compared to the fair value of first bond. Why? First bond oka reliable, verifiable external evidence. Whereas level 2 what you computed with your own hands, that is not a reliable external evident information as good as level 1. Therefore we call it as little less reliability number, level 2 and level 3. Sir, what has got that to do anything with our accounting here? Nothing, sir. The standard ka feeling is this. Put financial asset you recorded at fair value. If this fair value is recorded at level 1, it means that a number what you wrote against the asset, that is correct perfect number with no ambiguity or doubt. So if you pay any amount for purchasing this financial asset which is more than the fair value or less than the fair value, that is pakka gain or loss and nothing else, because asset ka valuation is very, very strong. On the other side, if you tell me that this is either level 2 or this is either level 3, then I have a little bit of doubt on this number. Because a number is not that trustworthy as level 1, this gap ni very confidently I cannot call it as a gain or loss. So the standard tells, go and check the facts and circumstances, go and read the contract if it qualifies to be recognized as a asset, like our prepaid staff cost. No sir, contract law nothing of that sort is written. Fantastic. Go off to PRL. So normally gap should go to PRL, but if fair value is obtained through level 2 or level 3 inputs, then we will also examine the possibility of recognizing it as a asset instead of booking off entirely to PRL. Then another example also is there, which is actually special case number 2. Special case number 2 is security deposit. Sir, I took a plant and machinery on lease for a period of 3 years. Every year lease rent I have to pay 4 lakhs, 4 lakhs, 4 lakhs. After third year, the plant and machinery whatever I have taken on lease will go back to the lessor. Okay. I am not teaching you now on how to account for this lease rent. This is covered in a separate standard called as Ind AS 116. There also you have to do present value technique and all. You have to recognize some asset liability and all that we will see later on. My point is, when you enter into a lease transaction, a huge high value asset, our owner is putting in your hands. So owner expects you to pay some caution deposit, which we are calling it as a security deposit. So apart from giving 4 lakhs, 4 lakhs, 4 lakhs rent each year, I first day also paid extra amount of 1 lakh rupees. But the 1 lakh one good thing is there. What is that? Refundable. Refunded security deposit. When will it come back? At the end of 3 years, 1 lakh. My question is, a security deposit, whatever you have given, is it a financial asset? No. Is it a financial asset? Yes, because we have a contractual right to receive the money. Right. Can I sell the security deposit to somebody? Can I sell? Sir, the lessor ka asset is there with me. If I am transferring the security deposit to somebody, somebody can have to transfer the asset also. Can I transfer lessor asset to somebody whom I want? No, I can't do that. So the only way of I handling the security deposit is just to hold it till the next 3 years. You can't do anything. Ideally, which method should be applied there? You have only one choice, holding it. Which method? ACM. But ACM, if I have to apply, initial recognition should be done at fair value. If somebody tells me that he will give me 1 lakh after 3 years, what is the fair value of that investment as on today? 1 lakh or less than that? Less than that. But today transaction value is how much? 1 lakh. Now there is a gap between fair value and transaction value. Imagine market interest rate is 10%. So 1 lakh you discount it to today. So it will be 75,000. Leave chiller. What is 75,000? The fair value of deposit. Present value of future cash inflow, which is the fair value as on today. Now if I ask you to write an entry for security deposit, the entry should be security deposit account debit to bank. If this standard was not there, you would have debited security deposit also with 1 lakh only. But the standard says, array, adi financial asset, you should recognize at fair value. If money is going to come long after 3 years, its fair value today is nothing but the present value at market interest rate, which is coming to 75,131 actually, but anyway. So there is a gap of 25,000. You answer me only one point, ma'am. Is 75,000 rupees, is it a quoted market price? You computed. Computed. And this is definitely level 2 or level 3, depending on a rate from where did you get it. Isn't it? So E gap 25,000, is it possible that I can also call it as an asset? Right. Now, in security deposit transactions, E gap, don't you think it is a kind of extra rent paid? Sir, first day I gave 1 lakh, sir. Lastly, he is giving me 1 lakh plus interest, or other 1 lakh he is giving me. Same 1 lakh. Are you getting interest income? No. That means there is some loss to you. Willingly only you are bearing that. Why? Because you want the asset on lease. That's the reason you are shut up and you are bearing that loss. So our 25,000 rupees loss, whatever is there, that now takes the character of lease rent. But at least every year you pay 4 lakhs, 4 lakhs, 4 lakhs explicitly and directly like that. In this transaction also indirectly you are losing an amount of 25,000, because today first day you paid extra 25,000. If he says that he'll give you 1 lakh after 3 years, ideally you should give only 75, but you are giving how much? 1 lakh. How much extra are you giving? 25,000. Now what it means? It means that your lease rent is 444. First day you are also paying an amount of 25,000. Ee 1 lakh lo oka 25,000 lease rent is there, 75,000 security deposit is there. That is how we are going to account. But did the lease come in set? Am I starting using the asset already? No, I'm still at 0 time only. That's why 25,000, like how we call it as prepaid staff cost there, here we'll call it as prepaid lease rent. But when you read India's 116, you understand that a prepaid lease rent is also debited to an account called as ROU asset. ROU asset stands for right of use asset. This is nothing but the asset on lease. Asset ki debit cheseyali sir ultimately. But the prepaid lease rent, there is no doubt on that. Like how we have prepaid staff cost there, here it is prepaid lease rent. No difference. Sir, what will happen to prepaid lease rent? What happened to prepaid staff cost? Amortized. This also will be amortized. Sir, but you told you will debit to ROU asset. Depreciation, sir. Amortization place, depreciation word you use. What is there? ROU asset number will come off to P&L account over the next 3 years equally to your P&L account. Khatam over. Now, staff loan ki security deposit ki, are you able to see the similarities? Sir? Both are same. Flavor change. Matter same. Initial recognition, fair value. What is fair value? Present value of future cash flow. Amount paid is something else. Gap is coming. You are recognizing it as an asset. Are you clear? Please pick up question number 60 if you have understood this. 60. Yeah. What's the page number? Read that question, sir. There is a security deposit question somewhere over there. It's there or not there? Oh, yeah. Okay, 62, sorry. Two questions got added. 62 you can do, or okay fine, 62 you read, you'll understand first. Containers Limited provides containers for use by customers for multiple purposes. The containers are returnable at the end of service contract period 3 years between Containers Limited and its customers. In addition to the monthly charge, there is a security deposit that each customer makes with the Containers Limited for rupees 10,000 per container, and such deposit is refundable when the service contract terminates. Okay, so the customer is giving today how much deposit to you? 10,000 rupees. The money will be given back to him after 3 years. The deposit do not carry any interest. Analyze the fair value upon initial recognition in the books of the customer leasing the container. Customer point of view is asking. Market interest rate for a 3 years loan is 7% per annum. So indirectly, 10,000 rupees if you are going to get after 3 years, ideally today you should give how much amount? 10,000 divided by 1.07 you do like that. 2 equal to also you press, you will get 8163. If somebody promises you 10,000 rupees after 3 years, today you should give them only 8163. But how much are you actually giving? 10,000. How much extra are you giving? 1837 rupees extra you are giving. See how he is explaining this. In case of security deposits, level 1 fair value is not available. Loan given ki security deposit ke quoted market prices are available. No. So you have to compute 8163 guard gave. You observed on stock exchange. No, you computed that level 2. So a gap. Therefore, in the above case, the fair valuation is based on unobservable inputs, and hence applying scenario 2, differences can be recognized as an asset if it meets the definition. Now, since the lessee gets to use the containers in return for making an interest-free deposit plus also monthly rentals, the lost interest representing day one difference between value of deposit and its fair value is like a prepaid lease rent and can be recognized as such. Prepaid rent, which is now called as ROU asset, shall be charged off to PRL in a straight lined manner as lease rent. That's all. Whatever we did for prepaid staff cost, ditto, same treatment, no change. Just situation different, that's all. Come to question number 68 also. It is same question. It came in the exam for 8 marks. Same question. A Limited has made a security deposit whose details are described below. Make necessary journal entries for accounting of deposit in the first year and last year. See that cunning fellow, he is not asking entry for full period, only for first year, last year he is asking. Assume market interest rate is 12% per annum. Anyway, date of deposit is 1st April 2011. Finishing date is 2016 March, so 5 years. Description is lease. Total lease period is 5 years. Discounting rate is 12%. Security deposit amount given is 10 lakhs. PV factor also he only has given 0.567427. Anyway, tell me sir, what is the fair value of the loan or fair value of security deposit? Multiply that to 10 lakhs into 0.567427, that is 5,67,000. So how much extra amount did you give? 4,32,573. Since this is a lease transaction, you will debit this to ROU asset, or you can also call it as prepaid lease rent. That's exactly the entry what you have got. Hereafter what will happen, tell me? A prepaid lease expense will be amortized to P&L account over the period of next 5 years. On that security deposit, you have to do normal ACM accounting. ACM accounting means what? Tell me the entries. Security deposit account debit to interest income. And any cash flow received you should write. Are you receiving any cash flow here? If you are receiving, I would record bank to deposit. But I am not receiving, so don't write that. And closing balance you write. Like that for the next 5 years you have to do. The 8 marks came in the exam. Highly overrated, but very cheap. So, I mean why? Listen sir, what did I tell you? A prepaid expenditure is actually capitalized to an account called as ROU asset. Now that you capitalize it to asset, when you amortize a tangible asset, we will call it as amortization or depreciation. Depreciation. That's why they are using the word depreciation. See, ultimately it has to come to P&L account over a period of 5 years. Prepaid staff cost, there is no tangible asset. That's a deferred revenue expenditure. Therefore, we are using the word amortization. This tangible asset is in my hands, no sir, or a truck or container or something I have obtained. Therefore, we use the term called as depreciation, nothing else. Ultimately, it has to come to P&L account. Are they ROU assets, sir? Listen, leases standard law, sir, just for your easy understanding. First day when you obtain an asset on lease, the entry what you will write is ROU asset account debit to lease liability. This 116 law, I will tell you again, is lease liability meeda you will almost apply method of ACM. This ROU asset meeda normal you will just provide depreciation. What I am telling you now is, this ROU asset anyway some amount gets recorded. Now to that, add this also. When you add this 4,32,000, what will happen? ROU asset account becomes much more fat. That also has to be depreciated. Normally, there is nothing great in this. Once you understand 116, this is child's play. But even if you do not know 116 also, you understood prepaid staff cost ka concept, no? Just treat it as prepaid lease rent. In that case also, you will amortize it to P&L account. Don't go with the names. Names have got nothing to do. How much, sir? See, if it generally undeterminable in the sense, in that case, sir, you can, okay, that is a special case, which is there, here. What is asking is, sir, you have made some deposit, but a deposit, when it will come back, life we do not know, then how will you account? How will you work out the present value? Example also is giving, what about electricity deposit? This is one of the example which we used in schedule 3 discussion, right? Sir, electricity deposit will come back to you when you surrender the electricity connection, right? Now I'll ask you, when will you surrender the electricity connection? You can't say don't know. You cannot say don't know. So either tell me that you know a particular date, after 10 years I will surrender, 15 years I will surrender, or tell me that I won't surrender at all. If you tell me that I won't surrender at all, the point is, if you surrender today, hypothetically, can you recover the deposit immediately? Right. What it means is in nature of a demand deposit. Demand deposit accounting is our next special case. 1 minute will take. So for example, Excel Limited invested 1 lakh rupees in a bank. This Excel Limited definitely has a contractual right to receive money. Therefore, this is pakka a financial asset. Extra is this is a demand deposit. So demand deposit means whenever I want, I can withdraw the money. That is called as demand deposit. Indirectly put, this is something almost similar to your current account or our individuals who open a savings bank account. It is almost similar to that. Demand deposit means whenever you want, you can take back your money, no questions asked. Tell me, sir, E type of current accounts, how much interest will the bank pay? Current account, how much interest bank will pay? No interest, 0%. Do you deserve interest for giving a demand deposit to a bank? No. Generally is 0%. You may be saying that, sir, I will hold the deposit for 10 years in your bank only. Will he pay you interest? Still he won't pay. Why? That is demand deposit. Whenever you ask, he has to pay you back. So this kind of money is not of big use to the bank. You are using bank only as a storage device there. Bank cannot do anything with your money because you can ask the money anytime. So he won't pay you any interest on that. Not only bank, any party you give loan which is recoverable on demand, you basically lose a right to ask interest in that case. It's as good as you have not given a loan only basically. But I intend to hold this loan. I will not sell it to anybody. I will only hold, I will only collect the cash flows whenever I want. In cases, sir, you still have to apply ACM only. You still have to apply ACM because my intention is never to sell this loan to somebody or sell this deposit to somebody. So ACM only I will apply normally. But ACM initial recognition is at what value? Fair value. What is the fair value of this kind of loans and deposits given? Good. It will be equal to transaction value. Sir, you told loan receivables ki fair value is present value of future cash flows. No, sir. Present value of future cash flows when the loan is recoverable after 3 years only, 5 years only, then I will do present value. Loan I may be recovering after 5 years, but if I want I can recover tomorrow also. No, this kind of loans ki no fool will pay you interest. That's why interest rate what you use for discounting also is 0%. Interest cash flows are also 0%. Therefore, fair value, transaction value both are same. So when you write this kind of assets, financial asset account debit to bank, whatever amount you write here, the same amount you will record here. So difference will not come. Demand deposits ki you will not have any day one difference. You may not be recovering it in the next 1 year. Still, if you want, can you recover? Yes. Therefore, a difference should not come. This guidance given in the standard. So if you ask me, sir, I have an electricity deposit. I am not expecting it to surrender in the near future, and when I will surrender also, I do not know. You may not know when you will surrender, but if you want, you can surrender tomorrow also and also get back your deposit. No, therefore the accounting will be done as if it is a demand deposit. Sir, you take any financial asset, it has to bloody fit into these rules. ACM loan, FETP loan, FET, somewhere it has to fit. Okay. Just because I said ACM, just because I say ACM, sir, every year EIR lo interest should come, no sir. Array sir, interest will come. If it is there, it will come. If it is not there, how will it be coming, sir? For example, demand deposit lo interest rate what you deserve is how much? 0%. So how can I apply EIR and do interest accounting? You don't deserve interest in that case. Either sir, I gave an interest free loan to employee. Contract lo interest is not there. But this loan can be recovered only after 3 years. I will artificially bring interest into the picture and start accounting it. That's exactly what we did, no sir. I gave loan to the employee only at 3%. Did I go to the market and bring 15% interest rate and did I account it or not? Is he actually paying me 15%? No. But still I accounted. Because adoko 3 year, 5 years loan. Akada interest ke I am eligible. So even if the employee does not pay me any interest, had he paid, how much he would have paid, how much loan I would have given, and a feeling I will account. But this is not that, the demand loan. So you should not go to market and bring interest rates and do present value accountings and all. Only level 1. Oh no. Correct. Not like that, not like that. Asset value, there is no uncertainty. So if you pay anything more than the level 1 fair value, that is a loss. If you pay anything less than level 1 fair value, that is a gain. But level 1 is a quoted market price. So quoted market price will be there for which kind of assets you think? Only for listed securities. Only for listed security which you buy on a stock exchange, unlo other agreements unde chance ledhu kada. But when I give a loan personally to you, my employee, between you and me, so many contracts we can keep. You should stay in my company only. So prepaid staff cost ka drama can come. If I buy a bond on a stock market, what contract will I have secretly with that company? The market lo purchased, sir. So market lo, if the fair value is 1000 rupees, suppose for some reason I paid only 900, 100 rupees is a gain for me. If I pay 1100, that 100 rupees is a loss for me. So whenever level 1 input is used, a gap will definitely go to PRL. Other than level 1 you are using means this is not a market based transaction. It is a personal transaction between you and me. So some agreement between us is capable of creating a asset there. Okay, so guys. Okay, now last aspect, sir. Last important aspect in special cases, which is loans within the group. Very easy, focus, very, very important, but very cheap also. Sir, throughout India, you will be many times seeing this term called as group. Group means parent company plus its subsidiaries. This is referred as group, not associate, not joint venture. Only parent plus subsidiary. Associate, joint venture calls I will do consolidation, but group on a word refers only for parent plus subsidiaries. If you don't have any subsidiary, but you are having 3 associates, you will still do consolidation. That's not called as group financial statements. Loans within group means who gave loan to who? Parent gave loan to subsidiary or subsidiary gave loan to parent. Now how to account this? In this case 1, A Limited gave interest free loan of rupees 10 lakhs to B Limited for 3 years. Market interest rate, let us say this is 10%. Now how should A Limited account this? How should B Limited account this? Who is giver of loan? A is giving loan, B is receiving loan. Of course, I did not wantedly tell you who is parent, who is subsidiary. That we'll leave it for a moment. But ask yourselves, for a giver of loan, what is the objective? Again, to collect the money back. Interest is not there because the interest free loan. So I just have to collect the principal amount. Between groups, sir, loan given to subsidiary, I will not sit in the market and sell it to somebody else. I am only going to hold it till the maturity. Ideally, which method has to be applied? ACM again. Similarly, B Limited who received the loan, for that fellow it is a financial liability. Financial liability which are in the nature of normal loans, you have to apply only ACM. That we will understand after covering financial liability discussion. Time being, remember it. All liabilities are accounted only using ACM. FATP later on we will see. So both A limited also should apply ACM, B limited also should apply ACM. ACM initial recognition principle is what? Fair value adjusted with transaction cost. Now transaction costs are not there. I want fair value of this loan today. A loan is going to come back to me after how many years? 3 years. It's 7,51,000, just rounding it off, okay? 7,50,000. This is the present value. This only is the fair value of the loan given or loan received. What you have to do is just accounting for this, you have to learn. Now, different scenarios, sir. Parent gave loan to subsidiary. In this case, parent books lo what entry will you write? Subsidiary books lo what entry will you write? Think from parent point of view, all of you. First of all, whether I like or don't like, I have to write to bank 10 lakhs. Loan receivable. Only at what value? Fair value, which is 7,50,000. Then there is a gap. Leave it. Come to subsidiary books. Subsidiary is receiving an amount of 10 lakhs. They have to also record loan payable under ACM only, which is fair value again, 7,50,000. Here they are having a gap of 2,50,000. This fellow is also having a gap of 2,50,000. Tell me, sir, here who gave benefit to who? Staff loan case lo employer gave benefit to employee. Otherwise, lessee gave a benefit to lessor, security deposit case. Here who gave benefit to who? Parent gave 2,50,000 rupees freely to their subsidiary, which is not recoverable. Correct? Right. This our standard guides you that. Go and debit this to investment in shares of subsidiary. Tell me, sir, why did the other company become my subsidiary? Because of my investment in their equity shares. Is that amount recoverable? Do I have a contractual right to receive that money back? Shares. No. So 2,50,000 is also as good as the investment what you made in the shares of subsidiary. Sir, parent company balance sheet lo one main account will be there. Investment in 80% shares of subsidiary. Against that, whatever money is there, amount you don't have a contractual right to ask because of the equity share investment. E amount also go and debit it there. This is parent books accounting. Investment in shares of subsidiary. Subsidiary books lo, sir, this is a money freely given to us by my parent company. It is just like capital contribution. It's a capital given. But are we issuing shares to them? No. So the entry what we'll write is capital contribution from parent company. Like you guessed it rightly, this will go and will reflect it under other equity. It's part of your other equity. Sir, parent giving money to subsidiary freely, it's like parent investing in subsidiary. Parent investment to subsidiary capital. But subsidiary is not giving equity shares, no, so I cannot credit this to equity share capital. I will open another account with the name of capital and park it in other equity. It's part of capital, sure, but not share capital. It is. This story, sir. Parent gave loan to subsidiary. Sir, hereafter what will happen? You tell me, hereafter what will happen in parent books? E loan receivable is there, no? On this you will go and apply ACM. When you apply ACM, what entries you record, you tell me? Every year you will record loan receivable account debit to interest income. If the subsidiary pays you any interest, in this case they won't pay because it is zero interest. But if you give it a concession interest rate and all, in that case something they will pay, no? So bank account debit to loan receivable. Like that you have to do accounting for first year, second year, third year. By the time you write third entry here, a loan receivable account becomes zero. That's magic of ACM. As you compound and receive the cash flows, loan receivable will become zero. Khatam over. ఆ ఇన్వెస్ట్మెంట్ ఇన్ సబ్సిడరీ షేర్స్ ఉంది కదా, దాన్ని అమార్టైజ్ చేయకూడదు సార్. అట్లాంటి పిచ్చి పిచ్చి ఐడియాలు తెచ్చుకోకూడదు. అది షేర్ ఇన్వెస్ట్మెంట్ సార్. అది ఫర్ ఎవర్ ఇట్ ఈస్ అవర్ ఇన్వెస్ట్మెంట్ ఇన్ ద సబ్సిడరీ. అక్కడ ప్రీపెయిడ్ స్టాఫ్ కాస్ట్, ప్రీపెయిడ్ లీజ్ రెంట్ లాగా యూ షుడ్ నాట్ డూ దిస్ వన్. దిస్ విల్ స్టే ఇన్ యువర్ బ్యాలెన్స్ షీట్ ఫర్ ఎవర్. ట్రూ, ఫైన్ సార్. ఆర్ యూ అండర్స్టాండింగ్ ఆర్ యు ఆర్ బై హార్టింగ్? ఓకే, రివర్స్ కేస్. Subsidiary gave loan to parent. Again same requirement. Parent books, subsidiary books. Amounts and all same to same, sir. Now parent is receiving loan or giving loan or receiving loan. So what entry you should write here? Bank account debit. How much money did I receive? 10 lakhs. But for me this is a loan liability, loan payable. Loan payable also ACMA. So here also you have to record it 7,50,000. There is definitely a gap of 2,50,000. We'll see what is that later on. Next, come to subsidiary. Subsidiary, this is a loan receivable from parent. This they should record at fair value 750. But their cash outflow is 10 lakhs. They have extra given to the parent an amount of 2,50,000. The gaps you have to fill up. Subsidiary, sir, parent when they gave benefit to subsidiary, parent called it as investment. Can this fellow call it as investment in parent? Subsidiary balance sheet lo investment in parent company ka shares will be there? No. So freely when subsidiary gives money to parent, it is in the nature of dividend distribution. Dividend distribution entry is what? Yesterday we discussed. Retained earnings to dividend payable to bank. Effectively retained earnings to bank. Go and debit this to your retained earnings. It is like a distribution of dividend. What is dividend given? For us a dividend received. This is a dividend income. Directly go off into your the treatment for this. Sir, in this loan within the group loan, total 3 cases are there. We covered only one case till now. Which one? A gave loan to B and the loan card repayment date is known. When is it? After 3 years. I may give it 0%, I may give it 2%, 5% concession. Anyway, treatment is same. Whatever we discussed is their treatment. But what you have to remember in this entire drama is, if parent give loans to subsidiary, then that gap is a benefit given by parent to subsidiary. Parent investment to subsidiary capital. When subsidiary gives loan to parent, then that gap is a benefit given by subsidiary to the parent. Subsidiary declared dividend, parent received dividend. Our model you have to account. I entry so there is nothing to remember or write in fact. The logic is important. So that's why this and this are matching, this and this are matching, like that. You have to understand the main crux of that. Right. What are the other 2 cases is, they are very cheap cases. Case 2, A Limited gave loan rupees 10 lakhs to B Limited at 0% interest. B Limited will repay. One second, sir. If you're writing, please write. B Limited will repay the amount whenever funds are available. The repayment date is not known. Whenever funds are available, then B Limited will pay the money back to A Limited. First case, what happened? You know the date of repayment. Here you do not know the date. B Limited will repay when the funds are available. So tell me, sir, when you do not know the date of repayment, how will you even work out fair value? Yes, sir. How will you do this case? B Limited will repay the money only when money is available with them. No. If you record a transaction value, indirectly you are saying that this is demand deposit. Is it not? If you record, you do not know when the money will come. Okay. Just because you don't know how to measure the fair value, you should not record loan given at transaction value. If you record loan given at transaction value, you are making it equivalent to demand deposit. The demand deposit. If A Limited demands money tomorrow, B Limited is in a position to pay. No, how can you record a transaction value? You cannot. So then what to do? Simple, estimate. A Limited and B Limited, group companies only know, sit and estimate when he is likely to have cash, and therefore when you are going to get back your repayment. Make an estimate. Based on that estimate, discount all the cash flows to today. Fair value will come. Do accounting just like how we did case 1. Case 2 ka accounting, case 1 ka accounting, ditto same. Okate point difference. What is that? Repayment date you do not know here. Earlier you know. Now that you do not know, estimate that date when that fellow will have money, when he will pay. Accordingly, when we will receive, based on that accounting will be done. That's all. Sir, but you are estimating, but estimate can be wrong, no? Exactly. If estimate is wrong, either you will receive money before the estimated due date or after the estimated due date. For that you already know what is to be done. Staff loan, what did happen? Did you remeasure the staff loan account? Like that only loan ka remeasurement will keep on happening for preponements and postponements. Nothing great. And this sum is not there where they they have changed it, they have estimated something and all. Theoretical questions 2 are there. Means e case lo how will you do one? You just have to write a theoretical answer. What is the theoretical answer you should write? You should simply say that the company should estimate when the funds will be available and when the loan cash flows will be repaid. And hereafter accounting will be just like case 1. B Limited will repay amount when funds are available. So here answer is estimate the dates when funds are available and loan is repaid. Once you know that, hereafter compute the fair value of loan. Now onward story is similar to case. Whether parent gave to subsidiary, subsidiary gave to parent, a drama anta same sir. Fair value ka number akote manaku teliyadu, that you will estimate and work out. Simple. This is case 2 ka guidance. Case 3. Loan given by A Limited to B Limited is a demand loan. What's the meaning of demand loan? A gave loan to B. Whenever A asks, B should pay it back. In this case, interest ka concept does not arise. Therefore, in this case, your fair value will be equal to your transaction value. But fair value, transaction value, when both are same, gap will not arise. So when gap will not come, where is investment, where is capital contribution, where is dividend declaration? Nothing will happen. I will write loan to bank, he will write bank to loan. Sir, every year interest accounting, no interest accounting, the demand loan. That's it. Now, whatever we have discussed till now, all this is applicable only in individual financial statements of parent and subsidiary, not in consolidated financial statements. Why not in consolidated financial statements? Sir, I am parent, you are subsidiary. I gave loan to you. For me, it is a financial asset. For you, it is a financial liability. When I do consolidation, you and me are not separate. We both are same. There is only single entity. How can I give loan to myself? So a loan receivable, loan payable in your books, both will get knocked off. Asala balance sheet lo nothing will be appearing relating to loan. So the entire discussion whatever we did, that is only for standalone individual financial statements, not for consolidation. Consolidation intercompany loans will not be appearing at all. So that is your loan cut case, sir. On this also one question is there, but that question numbers also are more or less the same example whatever I've given. 10 lakhs loan, 10% market rate, 0% contract rate, 3 years, 5 years, same drama. I'll show you the question, we'll go through it.